Good evening, everybody. Welcome to this webinar on, I guess, the investor's dilemma, and I'm certainly going to provide you with some solutions. Now, this is the online version of an event that we ran in Perth last Thursday night, which was a very kind of low-key discussion group, really, and it was designed that way so that everyone in the audience was able to get answers to the questions that were most important to them. This online format obviously doesn't have the advantages of being face-to-face, but what I would like to do is to encourage you to be as interactive as possible. We've got plenty of time to work through. I've got a fair amount of content to share with you. It's the most important things that I've learned over 30 years in the market. I believe that it's of great value to you, but you'll get even more value from it the more questions you ask. Now, just before I start, I just need to point out a couple of things with respect to licensing. First of all, I'm a representative of AG Capital Markets, and you can see my AFSL number and authorisations there. I may also make reference to a retail managed fund that I run on American stocks, and so therefore the details there of the Avestra Asset Management account service as well. So just to get that little bit of housekeeping out of the way. Now, the format tonight, to try and give you the best experience that I can, I'm going to divide that up into 3 segments. Rather than present a whole lot of material and then have questions at the end, I'm going to stop several times during the webinar and answer the questions that may have accrued. So can I encourage you to write your questions as I go through? Don't wait until we stop, because there'll be a bit of a time lag there as well. So as questions occur to you, pop them in the chat box, and I'll stop on a couple of occasions and address them. So let's get started. The first thing I really want to address is a bit of a big picture look at how the future is unfolding. Now, this is by no means an exhaustive list, but it's one that I think has the elements that are most important for Australian investors. The first one is that I think the overwhelming odds are that the Aussie dollar should move lower still. It's down a fair way. If you think back, it wasn't all that long ago we were above parity with the US dollar. We're now down around 73.5. I think the Aussie dollar, all the signs are that we're probably heading lower still. Now, you might say, well, so what? How does that impact me? I think the key thing is that it will tend to feed into inflation in Australia. And that's going to back us into a corner, because interest rates are already relatively low. We've got potentially inflationary forces working here, yet we've got a slowing economy. So the situation for investors in Australia is not really that clever, I have to say, and there are much better places for you to invest around the world than in Australia. I'm not saying you should abandon the Australian market, but it's going to be very hard going for quite a few years. The second key thing is I think that a GST rise is highly likely in Australia, and that's going to further add to inflation, and it's also going to add to your cost of living. So again, just another pressure that that investors who are totally Australian markets focused, are going to encounter. Now, interest rates and economic growth, and I'm talking on a global scale here, are going to be very low for a long period of time. So I don't think we're going to see any significant increase in interest rates around the world, and that means that the returns for investors that have been looking to live off fixed interest, or at least partially off fixed interest, it's not going to get any better. This is not a transient situation that we're in. I think the circumstances that we're in at the moment, with a stock market that's lagging, with an economy that's lagging, with bank deposit rates that are extremely low, I think is going to be here with us for quite some time. Now, The next thing is, I think the bull market in stocks is set to continue. And I have a number of forums that I communicate with members and also with the general public. And I've been very, very clear about the sort of things to look out for when this 6-year-old bull market is perhaps going to roll over into something else. And I don't believe that any of the 3 or 4 main precursors for that occurring are currently in sight. And I would think that we've got at least 2 years, possibly 5, possibly longer for this bull market to continue. But one of the things that I must stress is that whilst that's my view, I don't regard it as a prediction. I could change my view in 24 hours if the evidence was there in front of me, but at the moment it's not. And as all good cricketers know, if you just play the ball as it comes down the pitch, that's the best way to deal with things. And at the moment, there is no indication that this bull market, particularly in America, is over. And until those signs, and I know exactly what I'm looking for, until those signs become evident, then as far as I'm concerned, the bull market is intact and is likely to continue. And there are a number of other reasons for that as well, which I'll discuss as we go through. However, as I have been saying for more than a year, I would expect that as we progress through this bull market, that we will see increased volatility. And we're also going to see a narrowing market. Now, what I mean by that is the stocks that are performing well, that represent good value, are going to get smaller and smaller in number. So this is not a matter of just investing in the general market. I think if you do that, you are probably going to encounter some real issues. I expect America to outperform Australia during this period, and there are many, many reasons for that. The American economy is performing so much better than the Australian economy. The American corporate situation is so much better. And they just have a better way of doing business. And also there are sectors in America which do not exist here in Australia. So for many reasons, I think America will continue to outperform Australia, and as it has done over the last basically 6 years since the GFC. I expect that commodity prices will head lower yet and will stay low for some considerable time. Now, inevitably, during these sort of declines, you'll get people come out of the woodwork and tell you that commodities have declined to, record levels or whatever it might be, and that they've got to turn around and go up. We're seeing it with iron ore, we're seeing it with oil. But I've got to tell you, the fundamental situation is not that great for commodities. Supply is still significantly in excess of demand. Supply is increasing, and demand, if anything, is going off the boil a little bit. So I don't see the situation in commodities changing for probably at least 2 years, and it could be considerably longer. There will be a point to buy the BHPs and the Rios of the world, but we are not there yet, and I don't think we're even close. So please resist the temptation to try and pick a bottom, because at the moment, it's a falling knife that you're trying to grab a hold of. So it's not a particularly good thing to do. Now, the impact for investors, and again, I'm still at the big picture level here. Investors are living longer, we all know that. And so that creates a requirement for a significantly larger capital base. That's just the reality of life these days. People need a greater sum of money to retire on. On top of that, we've got globally, we've got slow economic growth, we've got ultra low interest rates, and that means that we're going to have lower returns overall from stock markets. Now, I'm not talking about specific sectors, because there are some sectors that are going to do extremely well, but I'm just talking about as a general broad brush comment. The slow economic growth with ultra low interest rates means that the returns from stock market investments, if you are diversified across the range, are going to be much lower than you've been accustomed to. So what that means is that investors have been forced to take more risk to get a better return, but that return they're getting is still inadequate. And that really, in essence, there is the investor's dilemma, that you've gone out on the risk curve, but you're not still getting the return that you want. So the question, and this is really the subject of the rest of this webinar, is where to go to produce a better return for the risks that you have to take, because it's not just a matter of a better return. The return has got to make sense in terms of how much risk you're going to take. And I am absolutely of the view that there are methods you can use where you can significantly improve your return without changing your risk profile at all. Now, I know that flies in the face of what people will normally tell you. A higher return means higher risk. That is just not a true statement. People that say that do not understand how you can generate a better return. There are tools out there that most investors don't know about, and if they know about them, they don't know how to use them. And it is possible to produce a better return without increasing your risk compared to what your traditional managed fund would do. So where to go if you want to get a better return? Effectively, you've got two broad avenues. The first one is the funds management industry. So that's just the traditional employer default option, or your choice of whatever employer or industry super fund that you want to use. Now, everyone knows what those returns look like. Everyone knows that they're not particularly getting a good return. They know that we're paying through the nose in Australia for those fairly modest returns. And a lot of people are in the position where they're looking for an alternative, but they just really don't know what that alternative is. So that's one option. The second option is that you can go the do-it-yourself route. Now, if you decide to go that route, either through a self-managed super fund or through just actively managing your own private funds yourself, then that requires a number of things. It requires some education, which is important. And it's not only just theoretical education, it's practical education. And unless you're getting that from someone that's actually been in the market for a few decades and has actually gone through and experienced all the ups and downs of the market, I read things that you can Google online, and I read lots of material that's out there. And yeah, it's from a theoretical point of view, it's all valid information, but what it misses is the practicality of how you apply that information in the market. So please don't think that you can just go and Google a whole lot of information and all of a sudden you're going to be a really sharp investor. It just doesn't work that way, because the market dynamics are such that the execution can be quite different from the theory. The second thing that you need is some really sharp research, because we're now in a market and an environment, and I think it's here to stay for a long, long period of time, and it's a stock pickers market. No longer is the process of buy and hold and diversification across all market sectors is no longer a valid strategy. Yes, it can produce a positive return, but I think going forward, that positive return is going to be something more like 3 to 7 or 8% at the most. Now, for most people, that sort of return is completely inadequate for what they need for their capital base. So we're now entering an era where stock picking is absolutely required. If you want to get a better return without taking a lot of risk, then you've got to be very good about stock picking, and that requires a lot of research. The third element is and I'm absolutely convinced of this, you need some form of mentoring for at least a period, because without that mentoring, you're subject to what the media will influence you to do. You are subject to what all the biases in your own head will influence you to do. It is really tough if you're out there on your own trying to apply what it is to making a consistent return when markets are becoming increasingly volatile. If markets are trending nice and smoothly, like they did in 2010 and then again in 2014, then yeah, investing is reasonably straightforward. You can get away with it. But what happens when you run into 2008? or 2011 or the next GFC, because there is another GFC coming. I don't believe it's imminent, but there is another one coming, and I'm absolutely convinced of that. And it'll probably be worse than the one we saw in 2008. So what do you do then when things get really hairy and you need a sounding board? So, you know, part of your DIY education requires that mentoring step. I just want to quickly touch on some of the reasons why investors get such a poor deal from the funds management industry in Australia. And they do, you know, that a lot of people reflect that. And I get a lot of questions around this subject. So the first point is that the funds management industry does have a lot of constraints. It's not like they're trying to do a bad job. It's just that they've got a lot of constraints in how they can operate. Most of the funds have a policy of managing risk by diversification. So what that means is they buy a bit of everything across the board. So you end up with, by default, some very good performers, you end up with some mediocre performers, but you also end up with some very poor performers. And with the Australian yearly reporting season just getting underway, we're seeing a lot of underperformance in Australia, a surprising amount of underperformance. And we've seen some very, very significant price falls in the 10 to 20% range from stocks that have disappointed the market. Now, these are all top 200 stocks. They will all be in the mainstream funds management portfolios, and they're all dragging on returns because the fund managers are pursuing this policy of diversification. And I believe as we go forward, as the market gets narrower and narrower in terms of the stocks that are performing, that's going to be a severe drag on mainstream funds management returns. The second thing is that they also have a mandate that limits them to a degree on various things, such as how much cash they can hold. Most funds are going to have to hold, or to be something like 80% invested most of the time, or even more, which means that if they see an impending GFC coming or some particularly rocky period in the market coming, there's nothing they can do about it. They've just got to sit there with the exposure that they've got. Some funds are also limited by the geography about where they can go. So, you know, in today's world, you don't want to have these limitations. The third element is that there is a fear of underperformance by the individual fund guys, and therefore the potential, if they don't, you know, keep up with the guy next to them or the fund next to them, quarter after quarter after quarter, that, you know, people pull their money out and these guys could lose their job. So there's that element as well, that we rate funds every quarter, and we really put these guys in an absolute pressure cooker. And you know, it's no wonder that they really don't feel like they want to take much risk. They all want to be like the guy next to them, because that way, if you all underperform together, then, you know, it's not so much of a problem. And the fourth area, and this is really the key one, is that because we tend to put money into funds, which then has to go into the market, we are forcing our fund managers to buy when the market is somewhat elevated. And when stock prices go down significantly, we then want to redeem our funds. We force the fund managers to pull money out. So it's not the fund managers that are doing a bad job. It's investors' psychology forces them to buy and sell at the wrong time. So again, this is just another limitation or drag on the returns that funds management in the mainstream can produce. So often it's about their interests and not yours. And I know a lot of people consider the management industry's fees are excessive. And I guess to wrap it up, the performance is just inadequate for investors' needs, and what you're paying a boutique price for, you know, basically that underperformance. So that's, after having observed what's been going on for the last 20 years, that's my most succinct appraisal of where the funds management industry sits in this country. So let's have a look at the option of doing it yourself. What do you need if you decide to take this on and be more active yourself? Well, at the very basic level, you need an online brokerage account. Now that offers the advantage of low transaction costs, and it still amazes me how many people I talk to that are paying $80, $90, $100 brokerage per transaction. You know, you can pay $10, and in some cases even a bit less. So if you're paying a substantial amount of brokerage, then you need to know you've got a lot of alternatives. The next thing you need is some basic knowledge, and part of that knowledge is the confidence to execute what you do reliably. Thirdly, you need an information source. That comes back to the research. And it's not just about stocks, you know, which stock to buy, because you can buy a great stock that's undervalued, but if the big picture dictates that all stock markets around the world are going to go down in some sort of correction, then it doesn't do you a lot of good. You're not going to be immune from that. So you also need the big picture so that you can adjust your cash and exposure levels. And you know, members of my group get that every day. They get constant commentary on what the big picture looks like, what their cash levels should be, what their exposure levels should be, what the best sectors to be invested in, and then that all happens before I even present anything to them in terms of specific stocks. So that's really, really important. And thirdly, you need support and guidance when markets are tricky, because you know, human psychology is an amazing thing, and you can have all the best information in the world, but unless you've got a rock solid disciplined mentality, then it can all come unraveled at that point. So they're the important things that you need. Now, my approach to the market is I know exactly what I want. I know what the business fundamentals look like. I know what the value looks like, and I know what the outlook looks like. And I'm prepared to go anywhere in the world that it takes to get that. Now, at the moment, there's really only two sectors in the world that really interest me to any great degree. They're both in America. One is in the biotechnology pharmaceuticals area, and the other one is digital technology. Now, the reason that I'm so clear cut on those two sectors is that I believe they're the only two sectors where the future earnings momentum looks to be pretty much independent of all of the triggers that are out there. You know, you've seen all the triggers this year with respect to Greece, China, when the Fed's going to start raising interest rates, you know, all these things that people worry about. These two sectors are, I think, going to continue to grow substantially, pretty much independent of all of those other factors. And there's not many sectors that you can say that about. And if I'm making assumptions about how I'm going to value a stock over the next 3 to 5 years, then I want to be confident that the growth in the sector is there. So let's look at biotechnology first of all, and I'm going to keep this really brief. You might want to do a little bit more reading on this yourself if it interests you, but this is the big picture. This is why I believe these sectors as a whole are going to continue to grow at an above average rate for, you know, the foreseeable future. So first of all, the pharmaceutical and biotechnology areas have just got this massive pipeline of cures for life-threatening diseases. There are currently 800 plus drugs in various phases of clinical trials, and you know, this is what's leading to the extension of life expectancy. And I can tell you what's coming through the pipeline is unbelievably exciting. You know, if you think you've seen some rapid medical development in the last decade, you want to see what the next decade looks like. It is absolutely mind-boggling. So a massive pipeline of drugs coming through, and it's almost impossible to envisage this process slowing down, because everyone wants to live longer, everyone wants to be healthier. So I just can't see anything around the world that is going to impact the growth of that sector. Now, the companies involved, and I'm really talking about the majors here. I'm not talking about speculative stocks. I'm talking about stocks here that are 20, 30 billion up to $200 billion in market capitalisation. That would comfortably put them in the top 20 or 30 stocks in Australia. They have substantial cash flows. and they are using some of that cash flow to reinvest in the business, but they are using the other part of the cash flow to buy back their own shares, which they believe is still good value. And unlike in Australia, where value is very hard to find, we can buy terrific growth companies in America that are still very attractively priced. So the companies recognise that, so they're buying back their own shares, they're cancelling those shares. That helps to drive growth in earnings per share, and that in turn drives the share price. It's a different model to what Australian business uses, but it's one that I believe works much better. Australians incredibly fixated on fully franked dividends. What it's doing, that process is sucking the life out of reinvestment in Australian business. So again, Australian investors as a whole are shooting themselves in the foot by demanding fully franked dividends. The Americans, I think, do it better, and certainly the overall return to investors, rather than just the dividend return, is a lot more attractive. The second area is digital technology, and again, it's just almost impossible to see what's going to puncture the growth of this sector. We've got a connectivity revolution underway. There are estimates out there that there'll be 50 billion devices connected over the internet by 2020. We're going to have our home connected through the internet, our car, wearable devices for medical purposes, for fitness purposes, for a whole range of different applications. So it truly is going to be the internet of everything. And of course, with that, all the companies that supply into that whole sector are going to do extremely well. The second area of digital technology is just the absolute explosion in mobile communication and payment technology. We're moving rapidly towards a cashless society. And again, every dimensional advance in the number of users online is producing some profit for the companies that supply into that particular sector. And the third key area that we're obviously hearing a lot about these days is relating to cybersecurity. And I don't need to, I think, elaborate any more on that. There are incredibly strong growth drivers for the companies that are providing solutions to cybersecurity. So those two sectors, I think the outlook looks terrific. Now, that doesn't mean that the share price is just going to keep going up and up. Clearly, they will not. They will have corrections. But I believe that the best companies in those sectors will have growth momentum that will sustain them. So as long as you can identify well-managed companies and you can buy them when they're below fair value, then you have stacked the odds substantially in your favour. So just thinking globally, and I'll stop in just a minute and take some questions. Australian stocks make up about 2% of global stock markets. So I think sometimes, you know, Australian investors are a bit narrow vision. They think that, you know, Australian stocks are really all you need to think about. We're 2% of the global market. That means you're missing out on 98% of the opportunities around the world. And as I said before, there are a lot of sectors that are overseas that just do not even exist here. So I would encourage you to adopt the attitude that looks like this. I know the characteristics of what I want to buy and the price I'm prepared to pay. So I'll just go wherever that is. Wherever that performance and that value is, then that's where I'll go. And if it's overseas, then so be it. You know, there's no mystery about buying stocks overseas. It's a pretty straightforward process. And then the third thing is be very clear about what price you want to pay and let the market come to you. Don't chase the price. And I constantly have this discussion with members and lots of people that they have this feeling that if their money is sitting in cash, that it's not doing anything. Well, if the market is a bit rocky as it is now, then being in cash is better than being in a stock. So in a way, if you're in cash at appropriate times, you're actually making progress because you're not making, you know, the value of your investments are not going down. So there is absolutely nothing wrong with sitting in high levels of cash and letting the market come to you on your terms. That's the way to be a smart investor. The market reality is we've got a tiny number of high quality growth stocks that have got sustainable earnings. They're predominantly in the healthcare sector, but they are in some other online sectors as well. So I'm talking stocks like Corporate Travel Management, Seek, Ramsay Healthcare, those sort of stocks. But there's not that many of them. In fact, there's only really about 50 stocks in Australia that tick all the boxes that I require to be fundamentally a sound company. The second thing is that they tend to be overvalued. Now, why is that? Why is it that Australian stocks tend to be so overvalued? And I did get a question come through online before the webinar, so I'll just leave that and I'll address it in just a minute when we take some questions. And as I indicated earlier, the most reliable high growth sectors in the world don't exist here. The pharmaceutical industry here is incredibly limited, and there's not much to shoot at in the digital technology space either. So we just don't have those sectors where you can feel really confident about the outlook. If you're looking at buying into the, let's say the commodity sector at the moment, I mean, how do you make a forward projection about how a stock's going to perform over the next 2 years? I mean, what's BHP going to do? Well, you've got to have a view on commodity prices, and that's just a huge unknown. So for me, I want to stay with sectors where I can feel very confident about the future earnings. Now, I just want to go through this quick example to point out the difference in value. So I'm going to look at 3 healthcare stocks in Australia: Ramsay Healthcare, CSL, and Cochlear. And I compare them with 3 of the giant pharmaceutical companies in America: Gilead, Actavis, which has now changed its name to Allergan, and another stock called Mylan. I'll just whip through this fairly quickly and then we'll stop and take some questions. Okay, so what I'm going to do here is just show you the market capitalizations. That's just the market value. The profit growth on a per annum basis averaged over the last 5 years. And thirdly, just look at the current PE ratio, or price to earnings ratio, just to get a sense of value. Now, using the PE ratio as a means of determining value is rough as a pineapple. So you wouldn't want to use just that. But for the purposes of this exercise, it illustrates my point. So CSL, $43 billion company, fantastic company. There's absolutely nothing wrong with them. They're a great world-class company. They've been growing their profits at 17% a year over the last 5 years, but they're expensive. You got to pay 26 times 1 year's earnings to buy that stock. Some of these numbers might have changed a little bit because I did prepare this slide a couple of weeks ago. Secondly, Ramsay Healthcare. They're a pretty sizable company, $13 billion, 24% growth in earnings per annum, but they're trading on 36 times earnings. Wow, that's expensive. And then Cochlear, it's a $5 billion company. It's a great company, but there's a fair amount of fuss about Cochlear, which I'm not sure that I agree with, because earnings growth over the last 5 years has actually been pretty minimal, as you can see there at 2% a year. Yet you still got to pay 33 times earnings to buy it. So, we've got great healthcare companies, but they're just so expensive. Let's turn to America. Gilead Sciences, which is one of the world's biggest pharmaceutical companies. You may not have heard of them, but they'll be certainly behind some of the brands that you would be familiar with. $165 billion company. That makes them just about the biggest company in Australia if they were listed on our market. They've been growing earnings at 40% a year. You can buy the stock for 10 times 1 year's earnings. The value difference between that stock and Australian stocks is just absolutely chalk and cheese. Actavis, or now called Allergan, again, is a huge company, over $100 billion, 42% growth per annum, 17 times earnings. Again, exceptional value. Mylan, a little bit smaller, but it's still a company of great substance, and again, still represents pretty good value. If that PE ratio is less than the average profit growth, then that's a a very reasonable start. Okay, I'm going to stop just there, and I'm going to take some questions. I had one or two sent through just before the webinar started, so I might just deal with those first, if I may, and then come back to some of the other questions. So the first question is that I've read plenty of predictions about a bear market about to start. What is my view of that? Okay, I think I'm going to deal with this a little bit more in the next couple of slides, but look, my overall view is that there are certain precursors that have to be in place for a major market top. They are things like excessive valuation or overvaluation in the market. Now, we certainly don't have that in America. The second one is over-exuberance. People have got to be really enthused about the stock market. You know, taxi drivers have got to be telling you that you should be buying stock XYZ. The sentiment in America at the moment is really, really quite poor. This has really been 6 years of people second guessing where the market's going to go. This has been the most hated bull market in history. We are so far away from an over-exuberant sentiment, it's not funny. And the third thing is that you need a substantial rise in interest rates that occur over a period of at least 18 months to 2 years. And I went through this a couple of weekends ago for people that watch my weekend videos, where I showed 3 periods over the last 3 or 4 decades when the interest rate cycle started rising, and how the fact that the stock market kept rising for 1 to 2 years after that started. So for all those reasons, we're not close to the end of this bull market at this stage and turning over into a bear market. So that's why I feel quite relaxed and comfortable. The second question I had just related to commodity prices. I've read about commodity prices. They are so low, they have to go up, and so we should be buying BHP and Rio. Well, look, my absolute conviction is, and I spent a lot of time absorbing material about what's happening with supply and demand in commodities, and I can tell you that we're a long, long way from getting back into balance. So I don't believe we're at the bottom, or if we are close to the bottom in commodity prices, then I don't think the environment is there for commodity prices to go up. So I wouldn't even be thinking about commodity stocks at this point in time. Okay, now I've got a question here. Need to look into US stocks and soon look into the Euro market. I'm not sure if there's a question there or not. So the next question is, why are Aussie stocks such poor value? Well, I think I explained that a little bit before, but I'll just elaborate on that. I think the issue is that we've got a relatively small pool of high quality financial performers, and according to my criteria that I use, barely 50 stocks in Australia that would get a second look from me from a fundamental value, from a fundamental business performance point of view. Pretty much all the fund managers know who those stocks are, and so everybody's got their nose in a very small trough, and as a result, it's forced the price up. And I think it's probably about as simple as that. We just don't have enough high quality stocks for the amount of capital that is trying to find a home in this market. And the other aspect is that 40% of the Australian market is overseas money. So, that's come in here because of the attractive dividends. So, that's not helped either. If that overseas money wasn't flooding in here, then our stock values would probably be a fair bit better. So there's a number of aspects as to why, but I think they're the key ones. All right, let's move on. I've got a formula that I use to aim to produce 25% a year. Now, there's obviously no guarantees about performance in the future, but it's a formula I've been using, and I've been able to deliver that sort of return, both for myself and also for others through various means. And I just want to explain to you what the main elements of that formula are. And it's not rocket science, it's pretty straightforward, but the difficulty is in the execution, as I alluded to before. So let's have a look at the elements of what's in that formula. Firstly, it's about identifying sustainable growth and value, and hence it starts with identifying the sectors you want to be in. And those sectors have got to have a really, really positive future outlook. The second thing is about making sure that you find value, do a fair value calculation, and resist the temptation to buy unless you can get that fair value. So for me, sitting in cash until the right opportunities arise is never a problem. At the moment, members of my group and personally are anywhere from 50% to 90% cash, and I don't have a problem with that at all, because while that cash is sitting there, it's waiting for an opportunity. It's waiting for the market to come to us, and in a sense, it boosts your returns if you can get a better entry. So I'm looking to buy financially robust companies which are highly likely to sustain 20% growth per annum in earnings per share for at least the next 2 to 3 years. So when I look at any sector or stock, if I don't believe the stock can sustain 20% plus growth in earnings per share for the next 2 to 3 years, then I just go and find another one that will. So if it's less than 20, it doesn't even get a look in for me. The second thing is to buy them below fair value, as I indicated before. It's the fair value calculation requires making a number of assumptions. Those assumptions require a pretty good knowledge of the big picture, and you being able to make an assessment of how things are going to unfold. The formula I use to calculate fair value mathematically is simple, straightforward. I could teach you in 2 seconds, but it's the big picture assumptions that feed into that equation that's the tricky bit. The next thing is to buy them after some selling has occurred. Now, you could buy a great stock, it could be below fair value, but if there's been a lot of buying and the price has still gone up, then it can still come back 10 or 20%. And we're seeing a bit of that now in America, even though there's some terrific stocks and they represent great value. Some of them have come back 15 or 20% in just the last few weeks, because there's just some irrational fears in the market about various things. So you want to try and buy after some selling has occurred, because if you can get a 10 or 15% better entry price, then you've just boosted your return by 10 or 20%. It's not hard to get your mind around that. Now, I alluded to this before, crashes and corrections, why I feel so confident and comfortable about where things sit at the moment. So let me look at 2 different market events. The first market event is, the left field mini crash, 9/11, someone flies a plane into a building, someone blows up a subway somewhere. Those sort of left field events can't be predicted, can't be anticipated, and basically you can't avoid them, so you should stop trying. And again, I talk to people who worry about the next event. Well, just stop worrying about it. You can't avoid it, you can't control it, but the consequences of it are minimal. If you own a great stock that's going to grow in the future and you've bought it below fair value, then if the price does go down in the short term, so what? It'll go straight back up again. History shows that. So just don't worry about it. Don't burn up any energy trying to avoid it. The key is in how one manages your investments. And again, this is where having a sounding board, having a mentor is so really helpful. Now, the other type of event is the next GFC, the next big one, whatever we decide to call it. And I'm convinced that there will be another big one, but equally I'm convinced that it's not imminent. And as I went through before, it's caused by gross overvaluation, it's caused by financial calamity, and it's also when there is a high level of investment and exuberance. We saw that in 1987, we saw it in the lead up to 2000, and we saw it in the lead up to 2008 for different reasons, but each time there was gross overvaluation and stupidity had taken the market to ridiculous levels. We don't have those three things in place at the moment. The second part, and if you would like to look at the video I did on YouTube on the weekend, I think it might have been 2 episodes ago, where I looked at the raising of the Fed funds rate against the stock market, and it's a real eye-opener, because there's people going to tell you that because the Fed's going to start raising interest rates that it's all over for the stock market. It's just absolutely not true. Now, the second thing is that the next big one never appears from nowhere. The signs are in the market action many, many months in advance. So for me, there are 2 signposts. One are the fundamentals, and I've explained what we look for. We look for gross overvaluation, we look for high levels of investment, all those sort of things. We're not even remotely close to that. The second thing is what you can see from a technical chart. And the signs are in the market action many, many months in advance. Let me just quickly show you what I mean. Let's look at the S&P 500 index on a monthly chart. So what you're looking at here is a chart that goes back to 1998. So you're looking there at about 17 years of price action. Now you'll notice that the market moves in cycles. It goes up, then it goes through a down period, it goes up again through another down period, and now we've advanced enormously. You'll notice the blue line in the middle here. When we've got a major bull market in place, that blue line is rising and the price of the index remains above the blue line almost the entire time. You'll notice a couple of little excursions below that blue line as we move through, which this is about a 6 or 7 year period, but really it's pretty mild. So the market has a certain character, if you like, during that period. Now, it's when the market starts to turn over, and you don't really see it too clearly on this monthly chart, you see it much more clearly on a daily chart, but when the market starts to swing more wildly and the price starts to spend more time below that blue moving average line, then that's the indication that the bull market is finished. And the character of this phase here, which I call phase 3, is quite different from what we saw in phase 2. It's just really, really different. So it's quite clear, and this was in November and December, and perhaps into January if you were a bit slow, but by January 2008, it was absolutely as clear as the nose on your face that the character of the S&P market was changing and that you should do something about that. Now, you didn't have to have any knowledge of the GFC coming, or you didn't even have to have knowledge of anything, to be honest. You just had to look at the chart and acknowledge to yourself that the character of the price movement was changing. And that was a warning flag that should have alerted you some 7 months in advance of the main part of the GFC decline. So it's as simple as that. Now, the only reason that this is difficult is that our mind struggles, if we've been through 7 years of a bull market, our mind struggles to make the switch to the fact that the conditions may have changed. But really, it's from a technical perspective, it's about as difficult or simple as that. Now, I just want to go through one example of a stock which I think is an absolutely world-class stock. I think there is a really good investment case can be built around this stock into the future. And then I'll just take some questions. So we're going to looking at Skyworks. Now, the sectors that they operate in, they provide gadgetry, very high-tech gadgetry for mobile internet and analog components for all the things that happen in the digital technology world. So they operate in sectors where strong growth looks pretty much assured for years to come. So I'm comfortable that this is a stock that, as long as they continue to be well managed, will get more than their fair share of that very, very strong growth in the sector. The key strengths that they have is that the industry recognises them as producing nearly perfect quality components. So they have a very distinct technical edge. They're not just another one of a massive companies that are providing semiconductor components into the digital sector. They've got a real technological edge, and their componentry can do things that other components can't do. And the sectors of strength for them: automotive, so with the connected car, the medical profession, and also the industrial sector as well. And that's, of course, in addition to being a major supplier to Apple iPhones. Now, the risks with a company like this: the whole sector, it's fiercely competitive. In fact, there's not too many sectors around the world these days that aren't fiercely competitive. They've got a fair concentration risk. They've got a small number of large customers. Apple is a big customer of theirs. If they lost that contract to Apple, that would be meaningful to the company. So, that is a risk. But then again, they're probably the best in the world at what they do. So that makes it far less likely that they'll lose that contract with Apple. The outlook for the company: they're looking to capitalize on this whole Internet of Things revolution. And that's just creating really strong demand for high performance solutions. And remember, that's what these guys are. They're not just providing a commodity, they're providing high performance solutions to the manufacturers that want them. And their recent quarterly report, which was last month, they provided extremely bullish guidance for 2015. In fact, the market was already expecting them to grow their earnings by something in excess of 20%. They further raised that guidance. So they're so confident about how their outlook is unfolding that they further upgraded that guidance. Here's a chart of their earnings history from 2010 on. You can see there's a very, very strong rise in earnings per share history, and really the way the outlook is going, I don't see any reason why that's not going to continue. So again, let me take a stop and see if there's any questions that I need to address. Okay. So the first question here is, it's difficult to get research on overseas stocks. Exchange rates complicates the issue. Actually, Brian, I disagree that it's difficult to get research on overseas stocks. In fact, I find the ability to access information in America on free websites far exceeds Australia. American investors are so better served by what you can get for free over there. It's not funny. I have no problem at all accessing all the data pieces that I need. There's one site that I pay a very, very small amount of money to access, mainly for convenience of how the information is presented. But look, pretty much everything you need is available on Yahoo Finance. So I disagree. I think the bigger issue is having the skill to interpret what the data means, and then once you've done that, to put it in the context of the big global picture that I talked about at the start. Like, how much exposure should you have this month, this year? That's an equally important question. So that's the sort of research where you've just got to spend an awful lot of time, reading and absorbing very broadly. You've got to understand currency markets. You've got to understand bond markets. You've got to understand a lot about a lot of things to put that data in perspective. The exchange rate, further complicates things. Look, I can understand he could say that, but again, when I first started transferring money to America when the dollar was 104, so clearly that's been very kind to me. And I think all the drivers are pointing towards the Australian dollar declining further over the next year or two, perhaps. And the low to mid 60s cents is entirely possible. So, and I don't see much upside. So personally, I don't see that there's very much risk. I think there is more downside than upside in the Australian dollar. However, even if the Australian dollar went up 10%, if you're making 20, 25% a year, and I've outlined that formula that's working, then you do that for a couple of years. Who cares if the exchange rate goes against you a little bit? If you're going to move your money there for a month or 3 months, then yes, you have a point because the currency could do anything. But as I've said to everybody, if you are going to go into the American market, then have a 1 to 2 year time horizon minimum, and allow the profits that you can make to basically swamp out any adverse currency reactions, any currency consequences. But personally, I don't think there will be. I think the overwhelming drivers are the Australian dollar will probably head lower. Next question: why not buy put options? I'm not sure what that relates to. But look, buying options, and this is really beyond the scope of tonight, but it's a conversation I'm happy to have with you, Clinton, outside of this webinar if you wish, because it's something that I'm doing actively, but I'm not buying options. I'm writing options using some very conservative strategies. Buying options is a low probability exercise for me, and it's not something that I'd really do, but there's a much smarter way to do it. So do I short the stock in a bear market, or do I stay in cash? And if so, what currency? Look, there's no overall answer to that. Yes, I can short the stock in a bear market. Yes, I go to cash. Will I stay in American dollars or Australian dollars? There's no overwhelming answer I can give you to that. It depends on the circumstances at the time. But look, I think the overall answer to your question is that there are things that you can do, there are tools that you can use that most people aren't using that are incredibly valuable. I think that's, the best answer I can give you at this point in time. You're not just stuck with buying stocks, and if they don't go up, then, too bad. You have a lot more tools at your disposal, a lot more flexibility than that. Next question. I mentioned that I'm happy for people to be heavy in cash right now. What are the risks that I see that cause you to say that when you see the US opportunities in certain sectors being good? Oh, good question, Troy. We're just going through a flat period at the moment. It happens. And if we are going to get a bit of a nervous market and a bit of a correction, then August, September is when it's most likely to happen, especially in the US. I've got a few ideas about why that is, but look, it just is what it is. There's a very high probability that August, September will be a bit weaker. It's also been nearly 3 years since the US market has had a 10% correction. So there are a lot of people that have got a lot of money in profit that may well decide to, dump and take some profit. I'm extremely positive about the longer term for those sectors, as I pointed out earlier. And one approach I could take would be to just say, well, okay, if there is a 10% correction, then I'll just sit through it. And that's quite valid. But I actually want to utilize my cash more efficiently than that. So what I try and do is to take profit off the table, wind myself back to a level of significant cash, and at the moment that's around 65% cash, so that then if there is a dip, a 10% correction, then I can get some even better bargains. So it's really just a matter of doing things to use your money most efficiently during a time when the market's the most nervous. Now, the exciting thing about where we're at now is that, yes, August, September is traditionally a weaker period of the year, but October to May, there's a 7 months run there that traditionally is the strongest time of the year. So we're on the cusp of a terrific opportunity, based on the normal seasonality of the US market. So that's why I'm just using this period to position myself in the best way that I can. Okay, so that looks like all the questions for now. So let's move on to the third section. I just want to take a look at another company which you might find of great interest. This is Gilead Sciences. It's one of my favourite stocks. In my opinion, this is one of the best stocks on the planet. It's also one of the best value stocks on the planet, as I indicated before. So let's have a very quick look at Gilead Sciences. They produce cures and treatments for HIV, hepatitis C, cancer, and a whole range of other life-threatening diseases. They're about $175 billion market cap company from memory. So, they're right up there with the Commonwealth Bank and BHP in terms of market size. $165 billion market cap. Their profit margins are extremely high. Their gross profit margins are, up around the 65% mark, which is extraordinarily high. Their valuation, for various reasons that I don't really have time to go into tonight, I could talk about Gilead Sciences for, half an hour. But for various reasons that are mostly irrational, they have an extremely cheap valuation. They have the financial muscle to develop or acquire new drugs. So if they want to pad out their pipeline, then they can just go and buy some other pharmaceutical research companies, and that's what they've done over the years. So I don't see anything that's really going to get in the way of the continued significant growth of this company. Now, the risks, again, in biotechnology, pharmaceuticals, just like with digital technology, it's a very fiercely competitive market. Patent expiry on pharmaceuticals is an issue that has to be managed as well. So there certainly are things that you need to be aware of there. But, taking those all into account, trading on 10 times PE is still, I believe, irrationally low. The outlook, they've just, again, provided quarterly earnings. The guidance was very bullish for 2015, and I completely agree with it. This is the earnings history over the last 4 or 5 years. You'll notice that there was a massive step change from the second half of 2013 into 2014. That was largely because of the launch of a drug that actually cures hepatitis C. It's been a massive, massive winner for the company. But you'll notice beyond 2016 that analysts are currently forecasting a bit of a drop-off in earnings per share. Now, this is the irrationality that I'm talking about. Analysts are just painting a somewhat somber picture of the future. I completely disagree with this outlook. I think factually there's every reason why the stock will continue to grow its earnings. So, but in any case, we're still buying a stock that's at outrageous value at the moment. Well, let me just take a look at a couple of those charts for you. So we didn't look at Skyworks. So let me pan back on Skyworks, and you can see this is a stock that was trading only about 18 months ago. It was trading at $25. It's been up to 110. It's pulled back a little bit lately after a sensational earnings report. But again, this is irrational fears about China and mobile phones and all those sort of things, which in time I think will prove to be incorrect. So this has pulled back to a very interesting buy price. So it's a stock that I like a lot. The other one is Gilead. pan back, you can see again, there's a very, very strong uptrend in place here that really started in 2012. It's been running now for 3 years. It's taken the stock from around $30 to 120, and we're just getting some consolidation that's happening at the moment during this week period. But as one of the previous questions highlighted, there are smart ways to deal with this opportunity. You don't have to just buy the stock. There are other tools at your disposal that you can use. So just please bear that one in mind. So just some final thoughts. When it comes to investing priority, my overall priority is protecting capital, and it should be yours as well. You know, don't just think about how much money you can make. You really want to look at what the risks are, and you want to have a methodology in place that allows you to step out of the way quickly if there's going to be anything nasty in the market. So capital protection is an absolute priority. As a consequence of that, if you restrict yourself to just buying the best quality stocks and the best value stocks around the world, then that goes a long, long way to protecting your capital. Because if there is a bit of a short-term blip down in the share price, then just wait it out. You know, if you happen to get caught out in the short term, just wait it out, because those prices will go back up again, as long as you've done the things that I've talked about. Now, for those of you that are perhaps interested in what I might be able to assist you with, so predominantly this webinar was for your benefit to understand the principles of how to go about making a better return without taking any more risk, or in fact with actually taking less risk. But some of you may be interested in what I can offer. So there are two broad categories of what I do. Half of my business is around education, stock recommendations, and mentoring. There is a bridging course which I'm going to run online, and that's going to occur in September. So that has got material that is not within our current online training course. And I'm also in a position from a time perspective to provide some additional one-on-one support through to the end of September. Once I get into October, I'm going to be busy with many other things, so I won't necessarily have the same flexibility. So between now and the end of September, I've actually got some more flexibility than I would normally have. So if anyone would like to talk to me about that option, then I'll give you my details in just a minute. The second broad category, and this might be more applicable to people that would like to be overseas but don't necessarily want to do it themselves for various reasons. And that is that I run a retail managed fund, and that fund has the objective to consistently generate 20% a year after all fees. Now, we've just rolled around the first year, and across the board, we've achieved that aim. So I'm pretty pleased with that, because stock markets have been stuck since about February of this year. They haven't got anywhere. Yet we've still managed to achieve that objective by owning really large cap blue chip companies, but it's just been in the way that we've done it. Now, there's no guarantees around that return, of course, but as I've been at pains to explain through this webinar, the process that I use, if you apply it in a very repeatable way, it is a very robust approach. And it works for me, and I'm quite confident that it's going to continue working in the future. The second thing that I think is also important is people want to be able to talk to their fund manager. I think that gives them a great deal of confidence, and that's something that I make available. If you did want to participate in that fund, then what goes on in that fund is extremely transparent, and there's a very high level of communication between myself and the members of that fund. So it's quite different from what you would have seen in any other kind of managed fund. It doesn't have the handcuffs that I talked about at the start. We've got complete flexibility on how we go about things. So I'll just put my contact details up on screen, and then I'll deal with the last few questions. So there's my email address if you would like to get in touch with me and arrange a time to talk. I would love to do so, and there are more details on the website. So let me come back and just see if any other questions have come in. Not at this point in time. So hopefully this has been of great value to you. I think that I can add a lot of value for those that would like to go down that path, that would like some assistance. Personally, when I started my journey nearly 30 years ago, you couldn't actually, there wasn't people like me around. There wasn't education. There wasn't much of a focus on the stock market and technical analysis and all that sort of thing. So it was pretty difficult. So I spent 15 years wandering around in the darkness trying to figure out how to do things, and it cost me a lot of time and a lot of money. So I do not recommend that process at all. The reality is that successful people surround themselves with specialists in various categories, and they pay them a bit of money to get the best advice in the best direction, and I commend that approach to you. Okay, so I've got a question here now. Does my fund hold cash at the moment? Yeah, absolutely. John, we're 65% cash across the board. It varies a bit because this is an individual account-based fund. It's not like your normal fund where you just put your money into a pool. Every investor in the fund has their own individual account, just like your own bank account. You can see that online. And yeah, so it's very transparent to you what's going on. Some of the accounts vary in their cash level depending on when they actually funded it, but across the board, the average at the moment is 65% cash. We've only got a small number of stocks open. We're very, very nicely positioned at the moment for the opportunities that I think will present over the next 4 weeks or so. So, I'm pretty excited about the run into Christmas and then into the first half of next year. Okay, well, that looks to be all the questions at this stage. So thanks for your participation. I hope this was of value. And well, if you've got any questions at all, just send me an email and let's just talk on the phone. I'm happy to do that. I find it's the most direct way to to answer your questions and help you sort out what you should do. So thanks, everyone. Talk to you soon. Cheers.